Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the podcast, I talked to Alastair Laing, who is the CEO of CG Asset Management, who are the managers of the Capital Gearing Investment Trust, ticker CGT. This is an investment trust which is designed to cope with the vicissitudes of markets and deliver a modest but steady and consistent return from one year to the next. So my first question, Alastair, has to be that this year has been very exciting. There's a lot going on, very volatile. Mr. Trump in particular has introduced a random factor into the way that markets and economies are changing. And I think for many people, trying to get their head round all that is going on is not been easy. So perhaps we could start by just talking about what's happening in the bond markets, the government bond markets, that is, where the big picture seems to be one of rising long-term bond yields, but some interest rate cuts at the shorter end of the maturity curve. What is actually going on behind these moves, do you think?
Hi, Jonathan. Yeah, rising yields is definitely the key picture. That's been the case in the UK and pretty much in most major developed markets. So to rising long yields, as you say. So to frame that, the UK 10-year has gone from 4.5 to 4.7. And the 30-year that was getting a lot of attention in the press from about 5.3 to topped out about 5.7. So that's the move over the last month. But the first thing to say is this has been a global move. There's been a lot of commentary about the gilt market specifically, and in the UK that makes a lot of sense. But this has been something that has been seen in all developed markets. There's a few aspects to it, but one aspect has been the slightly stickier and now rising rates of inflation. So I'm sure everyone will remember in 22-23, there was a burst of inflation, which came back down. And over the last 12 months, we've seen inflation tick back up again. So UK inflation is back up above 3%. And on top of that, there's been real concerns about fiscal sustainability and government spending in the UK and globally. Some politics roiling through the UK, through France, through America. So all these factors have combined to push global interest rates higher, and the UK certainly has not been immune.
Yes, so it's too simplistic just to extrapolate from what's happening to gilt yields and say it's all the fault of the government over here. It's a global phenomenon as well, at least to some extent. Do you think all this stems ultimately from what President Trump is doing, his rather erratic methods of policy making, shall we say? Or is it actually a reflection of some broader global phenomena that is driving up inflation in the short term, and maybe some other factors as well? I mean, one thing that is particularly interesting is that while longer bond yields are rising, as you say, what appears to be also happening is that inflation expectations in the longer term seem to be remarkably static, at least as derived from market prices. So how much is this Trump and how much of this is a temporary phenomenon?
Great question. Undoubtedly, Trump has had a massive effect. We say Trump, but essentially what happens to American interest rates has a big effect on UK interest rates. I would say there are different dynamics, and this is part of what makes it so confusing. In the US, there have really been a couple of key drivers. Firstly, exceptionally high deficit spending by the government, much higher in the US than in the UK. Secondly, there has been a significant undermining of some of the key institutions that investors rely on, the undermining of the Federal Reserve, the increasing politicization or political flak thrown at the Federal Reserve has been a very important factor. And thirdly, and most recently, there's been some questioning about the legality of tariffs, the executive orders used for US tariffs, which on the face of it would seem a positive thing for the global economy. But from a US perspective, the tariffs themselves are expected to raise significant tax for the US and be one of the factors counteracting the growing deficits. So really, you've got government spending and institutional issues in the US. In the UK, we've had some different issues. Firstly, a long-running point that really started with Liz Truss and has continued since has been that defined benefit pension schemes have essentially ceased buying large amounts of gilts. So that's a kind of technical factor. I won't go into the minutiae, but essentially through a perverse kind of incentives, defined benefit schemes were forced to buy more and more gilts as interest rates got lower. And as they subsequently rebounded, a lot of these funds are now in a well-funded position. They don't need to buy gilts anymore. So that's removed a big buyer from the market. And when the next marginal buyer, either overseas buyers or UK private clients, for example, maybe some of your listeners, simply require a higher interest rate. And I would say as a final point, it's interesting. I think it was Hargreaves Lansdown, one of the platforms, reported that the highest volume of purchases, not by value, but by number of trades, was actually the long gilt. So I think it was the 2053, something like that. But anyhow, you are just now starting to see interest rates getting high enough that certain private clients are stepping in. Suffice to say, there are lots of different dynamics going on in different markets. But if you step back, these markets are moving very much in parallel, but they're all going higher. And this does make the political questions difficult. No doubt, Labour have a very tough budget coming up in the autumn, and tax rises seem to be very much on the agenda, even those taxes that have been ruled out.
Indeed, at least ruled out for now anyway, and several times that's been said. That doesn't necessarily mean we can have 100% confidence in that being the outcome. There's still an interesting dynamic there, which is that if on the one hand you know the markets are a little bit concerned about inflation and government spending, the rising bond yields will, other things being equal, you'd think, help to put a bit of a dampener on that economic growth, which is what Liz Truss and the current government in the UK keep on reminding us is what they're trying to rely on to get them out of the fiscal hole they're in. But if economic growth starts to slow down, as it appears to be doing a little in the States, is that at some point going to reduce the inflationary pressures sufficiently that it will allow those bond yields to come back down again? In other words, I guess what I'm asking is there a potential buying opportunity coming for long-dated government bonds, precisely because the yields are getting to a point where people are prepared to take the risk of that higher duration and higher risk involved in price movements that happen at those levels of yield?
Yes, I think yields are certainly higher and more attractive than they have been, making now a fundamentally more attractive time to buy longer duration bonds, certainly than over the last few years. However, that's not to say that this slide could not go quite significantly further. Certainly, that aspect of the sell-off that is being driven by concerns about fiscal sustainability, these don't seem to be going away. Indeed, there's a growing kind of thesis that essentially it will take a crisis in the bond market to force onto politicians and really, I guess, their electorate the stomach to push through some of the structural changes that need to occur. A good example of that will be looking at the issues that the Labour government had getting through the welfare bill. In the absence of a crisis, it's clearly very difficult to deliver this kind of reform. You'd say same about pension arrangements. There are few people that believe our current trajectory is sustainable. And whilst the curve has steepened a lot, that is to say, long interest rates have risen more rapidly than short interest rates, it's certainly been steeper in the past. So, I mean, certainly looking at our own portfolios, we have increased our purchases of gilts. We have increased our duration of gilts. Our gilts are all index linked, but we still have that duration quite relatively short. We haven't yet pushed out into long gilts. We've got our eye on it, but we would say values have improved, but we'd still be concerned there's further to go.
So private investors may be increasing their holdings of long-dated bonds, but you're not, I think, and you're sticking to mainly buying index-linked and mainly doing so at the shorter end of the curve. Perhaps you could just explain for anybody who doesn't understand how duration works. It's a measure of interest rate risk, effectively, and interest rate sensitivity, and how long to maturity the bonds have to run. Perhaps you could just explain that and what the mechanical effect of that is on bond prices.
That's correct, yes. Duration and maturity are very closely linked. As you say, it's a measure of the sensitivity to the change in interest rate. Essentially, as you buy longer bonds, they become more volatile. They become more exposed to the change in expectations. I guess going back to your original question, we do think that it will be very hard for sovereigns to sustain their debt with these high levels of interest rates. They're very high levels of public indebtedness, and it will be very hard to continue to pay these kinds of levels of interest rates. As new bonds mature and they have to be refinanced at these higher rates, it will increasingly place strain on the public finances. And we think ultimately, if this is unsustainable, it won't be sustained. So we do think over the longer term, bond yields will come down from these levels. There are plenty of tools that central bankers have come up with to try and help to keep interest rates at manageable levels. However, it could well take a crisis to bring about the kind of fiscal changes that will then allow the monetary changes that will bring interest rates down. So it really depends on your timelines and your tolerance for loss. These kind of interest rates we're seeing now are historically quite attractive. So I'm certainly not saying that a brave private client purchasing longer bonds is doing anything foolish. But there could well be a lot of volatility on the way through. And certainly for us, given the risks to the macroeconomy, we're waiting a bit. I'm looking for a little bit more value before extending. But we have extended our duration in our UK inflation-protected bonds, our maturity, let's just call it, from about 4 years out to about 8 years. So we have responded, but we don't want to be taking on too much duration with this kind of negative momentum.
So just before we leave this subject, I could make the point that a lot of governments are facing fiscal crisis, potentially, and we may not be the first to have a crisis that affects the government of the day. You only have to look across the channel to see what's happening in France and for other European countries. And the US, as you say, also has a big fiscal problem. But would it be right to say that investors should be looking not just at nominal yields, but also at real yields? That is, after taking account of inflation. Because I think what you've been saying is that real yields from index-linked issues in the UK and US are much higher than they've been for quite a long time. So is it the higher real yield that is attracting you in relative terms compared to what you can get in nominal terms from buying a conventional gilt or treasury?
Yeah, so I guess to just frame things a bit, the nominal 10-year yield, the conventional 10-year yield in the UK is about 4.7%, and in the US is about 4.3%. So on the face of it, well, in practice, UK interest rates are just higher than the US. But the other factor is that UK inflation is a little higher than in the US and expected to be so into the future. So 5-year inflation expectations are about 2.5% in the US and a bit over 3% in the UK. So what this means is that the real interest rate, i.e. adjusting for inflation, is very similar between the US and the UK. I guess how we would look at things is that the big risk for buyers of any bonds, but really long bonds, in our mind, is the risk of inflation being higher than you anticipate. There's a very, very long history of investors underestimating inflation. Indeed, over the last 25 years since the turn of the century, by our calculations, investors in the US have underestimated inflation by about 1% per annum. That has been the case in the UK as well. That is to say that UK index inflation-linked bond returns and US inflation-linked bond returns have turned out ex post to be about 1% higher than holding conventional bonds. We think that will continue into the future. And what's more, we just don't know why any investor would take the inflation risk, given there's an opportunity to be protected against it. I think a final point, and this is really one for the kind of nerdy investor, but if you buy a UK index-linked government bond with some duration, it comes with a very low running yield, which means if you hold that bond to maturity, the bond principal increases with the rate of inflation. None of that is taxed as capital gain. You pay income tax on a very low yield. So as long as you can hold it through to inflation, it's an extremely tax efficient way of holding, say at a 20-year, you can get about 2.5% real. That is to say that you will essentially achieve inflation plus 2.5% over 20 years, suffering a very low rate of tax on that. And that's actually a pretty reasonable return. Equities over that time period are likely to deliver a higher return, call it 4 or 5% ahead of inflation, but you will pay tax on that, both on the dividend stream and the capital gains. So it's quite easy to see, particularly outside a tax shelter, why it is really quite attractive for a certain type of investor with a very long horizon and UK spending requirements in the future to be buying inflation-linked bonds at these levels. It just could well be a volatile ride. So it's important that any investor is prepared for that.
Yes, that's the reason why I may have tested some listeners' patience by starting off with talking so much about the bond market, index-linked and so on. It's not something we talk about a lot as far as this podcast is concerned, because obviously our subject is investment trusts. But what's happening to real yields does underpin the whole valuation of markets everywhere around the world, equity markets as well. So it's actually a fundamental factor that perhaps we should be spending more time on, at least at the moment. It's been a long time since real yields were at this level, as we've said, but that does bring us on nicely to what's happening in the equity markets, where equity investors don't seem to have noticed particularly that this is the case. There may be more attractive options out there in the gilt market or the treasury market, but we continue to have astonishingly good performance from a lot of equity markets, all-time highs for the UK equity market, for example. Could I call this an annus mirabile, perhaps, as far as the UK stock market is concerned? And also, of course, the US in particular is at very rich valuations. So what's happening here? Is it that investors globally just haven't grasped the significance of what's going on in the bond market, or is it explicable by some other means?
I mean, it's a very complex picture globally, but I guess to frame it in its simplest, we would draw quite a stark difference between US equities and all the rest. And US equities, as defined by the S&P 500, 40% of that index is in the top 10 stocks. It's just a very high concentration to technology and really the AI story. That is incredibly, incredibly important part of this. And, I came of age professionally in the year 2000. That's when I graduated and I started working. My first job was over in New York, working for a venture capital fund. And I walked straight into one of the biggest bubbles of all time in technology. And maybe I'm very prone to seeing bubbles everywhere, but it really looks a lot like a bubble to me. I remember very well in 2002, a famous quote by the chief executive of Sun Microsystems, which is worth digging out. But at the very essence, he said, at 10 times revenues, you didn't need greater disclosure. You didn't need more detailed analysis. What were you thinking? And essentially, we have a situation now where more than 30% of the value of the S&P is greater than 10 times revenue. That's actually a higher portion than during the dot-com boom. Now, there are very, very different dynamics at play, but it is no doubt a fairly extreme position. So the AI story has been incredibly important to the US market. And we are extremely concerned that the hyperscalers are looking like they'll spend somewhere between 300 and 400 billion of capex on an arms race building out data centers. We're extremely concerned that the return on that capital expenditure is going to be fairly low. They're going head to head with each other now, essentially on AI, cloud, computing, all of these big beasts going at the same market. And I think the outcome of their investments will change society in extraordinary ways, a bit like the second railroad to Darlington during the railway booms of the 19th century. I think a lot of this capital expenditure is going to have very poor returns and be a drag on investment for really decades to come. So we're extremely worried about the US. I mean, in sterling terms, the US is actually only flat this year. And I think, as you've pointed out, the European markets have been great. The FTSE 100's up sterling terms about 12%, I think, in capital terms. European markets about 14%. Even the investment trust market, I believe, is up about 12% year to date. So, there have been a lot of strongly performing equity markets, but I think what all of those markets have in common is they started from much, much lower valuations than the US. So no doubt they've been buoyed by some of the animal spirits flowing over from the US equity market, but we believe fundamentally they're in a much, much better state, underpinned by much more sensible valuations. That's not to say if the US sneezes that everywhere can't catch a cold, but we think that it's a far stronger foundation that a lot of these other markets are building on.
Let's just take the UK equity market for a moment. We know that there's been something like 3.5 years of steady outflows from UK equity funds, something we haven't seen for, at least in my memory. But more recently, there has been some evidence of a little bit of extra international buying at the margins of the UK equity market. You hear from one or two investment trusts, for example, that they see some American buyers coming in the afternoon. But it's been pretty small scale so far. Nevertheless, the UK market has moved ahead nicely, suggesting that if there is a significant change in fund flows from here, then the UK equity market could actually do very well indeed, given its current valuation. So it's all quite a complicated picture, I suggest.
Yeah, and look, I think the analogy with the dot-com boom can be overplayed. It is more complex, but in the 15 years running up to the year 2000, the US wiped the floor compared to the other developed markets. And that difference very considerably unwound. 2000 to 2003 was a bear market for all of these markets, but Europe very significantly outperformed the US. So I think the relative performance story is extremely strong. Then the only question is an absolute one. In the same way that global bond markets are very intertwined, even though there are different dynamics in the different countries, I think there's a very similar case to be made of global equity markets. In the short term, they tend to move together.
Yes, so if you're a professional investor, you can always say, well, look how well I've done by avoiding the US. I've outperformed the US market. But on the other hand, I'm still down 5, 10 or something %, which is not exactly what people want to hear. So this is where you and others who run funds like yours come into play, because one of your promises you make to your investors is that you will protect them against significant drawdowns, and therefore you won't see huge absolute declines at any point, whatever's happening to the market as a whole. You've done that over the past few years, and indeed as long as this trust has been going. But it's perhaps in more recent years you haven't produced such positive absolute returns as you would have liked. I think that may be a fair comment to make. Before we leave the macro picture, though, one other thing I wanted to mention is that it's important, particularly for sterling investors, about what happens to the dollar-sterling exchange rate, and indeed the exchange rate against other overseas markets. You mentioned how the returns from American equities, unless you've hedged them, have been hit by the change in the dollar's value this year. What do you think the outlook for the dollar is now? It's one of President Trump's ambitions to get the dollar down, and so far he's succeeded a little bit. Where do you think we go from here? Because this has a big impact on how much you might own in UK sterling assets when you're putting together a portfolio.
That is a very difficult question. At the start of this year, we moved to our highest weight in sterling, which we still have. So we have about 70% of our portfolio assets denominated in sterling, which would compare to a few years back about 50-50 sterling and overseas. So we have increased our sterling weight. Given the dollar has pulled back quite a long way over the last 6 months or over the year to date, some of that move has occurred. These trends do tend to go on a bit in currency markets, but it's important to acknowledge some of that move has already occurred. It is quite easy to look at the UK, our fiscal situation, some of the vulnerabilities we were talking about in our government bond markets, and make a fairly bearish case for sterling. But as you also say, France is seeing major political issues. Japan has very high levels of debt and increasing interest rates. There are political issues and institutional issues in the US. So I guess the dollar was very toppy at the start of the year. I think we can say it's less toppy now and may well have a bit further to go. And that's why we have lower weights in overseas currencies in the dollar than we have historically. That said, we don't want to hold nothing because these are difficult calls in the currency market. And historically, the dollar has performed well in times of global recession. I mean, there really is a strong question as to whether that will continue, but it's hard to say with certainty that it won't. So, yeah, all that wrapped in together, we have lower weightings in overseas assets. As you said, that's a pretty pronounced trend with global investors. People have very dramatically increased their US asset exposure over the last decade. And I think at the margin, we're seeing investors in a lot of countries just tamp that down a bit.
Right, we're about to come on to the investment trust sector itself, which is, of course, the main reason why people listen to this podcast. But I want to add one last point about the global picture. We have seen an extraordinary performance from gold, which has gone up to 3,600 an ounce, a record high. And in sterling terms, that's been even better because of the exchange rate differential, gold being denominated in dollars. I know you don't own a lot of gold. We talked about this on podcasts before. I think it's fair to say that you and your fellow directors have different views about this. But gold must be telling us something about what's going on in the world as well, not least the added layer of geopolitical concerns and the policy uncertainty created by Trump. What do you think the gold price is telling us?
Well, I think you make a good point. There are a lot of factors that are driving gold purchases. I think we've seen actually a lot of gold go into the US, which is interesting. I think there has been significant retail purchasing of gold. It has been a very strong performer. It has real momentum. So all of the attractions to gold you have outlined, or some of them, and frankly, there are more. It's easy to make a bull case. I guess the question is, does gold have some fundamental value? Is there some level that it should trade at, or is it just a speculative asset such that if people feel like buying it, they buy it and it goes up, and if they don't feel like buying it, it goes down? And that really is the issue that we've had with it all along. It's just incredibly hard to analyze and incredibly hard to find a framework by which you can be secure in holding it in large amounts. It is highly volatile. When it's going up, that volatility is brilliant, but it's had history from 82 through to 2000 of falling, losing 60 to 70% of its real value. So it's a very hard asset to nail down. We can absolutely understand the attractions, and maybe there's a bit of sour grapes because we have not had enough in our portfolios than we should, but we probably wouldn't just ride it on the basis of momentum. I think you'd need to have a bit more conviction. So I'd say well done for everyone that's got it, and it could well have further to go, but we prefer to try and analyse financial assets with a yield than to kind of analyse the momentum on an asset like gold.
Yes, and of course it's very volatile. That could also work against your mandate, which is to try and avoid excessive volatility, as I mentioned earlier. You have done that, as I said, but not perhaps as effectively as you would have liked over the last 2 to 3 years, because your shares have moved to a discount, despite your buying back a lot of them. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So if we look at your investment trust exposure within the portfolio at the moment, have you made any significant changes to the amount you have invested in trusts? And it is still your preferred asset of choice for risk assets, I think it's fair to say.
Yeah, so for the benefit of your listeners who don't follow us closely, yeah, that's right. We are a little unusual. Our equity exposure is mostly via other investment trusts. So we are poacher turned gamekeeper. We run an investment trust that predominantly invests into other investment trusts. And our CIO, Peter Spiller, has been investing in these markets since 1982. It had a phenomenal track record over this, getting on for 45 years. And we have a huge amount to thank the trust sector for. It has been a very strong performing sector and has allowed significant long-term performance to be generated. As we analyse the sector at the moment, I think a bit like some of the UK market and the European market more generally, we'd say it has a massive relative appeal. But we are concerned about the overall prospects for equity markets. We should definitely point out and make clear the last couple of years, investment trusts have significantly underperformed a broader global index like the MSCI World, and very specifically, it's underperformed US equities, which have been the main driver of the global index. And as we see it, that's really been the very strong tailwind of AI stocks, these hyperscale AI stocks. Investment trusts have very low weightings there. And it's also been the emergence of wide-scale discounts within the investment trust. It's not quite half and half, but for back-of-envelope kind of work, 50% of the underperformance has been underweight the kind of AI mega cap US question, and 50% has been widening discounts. We strongly believe those headwinds will turn into tailwinds. So over the next 5 years, we'd say this is a great market to be invested in, precisely because it hasn't had the exposure to those areas that has got a bit blown up. But there's also another factor that is really important, in part in response to the widening discounts that we've seen and the emergence of investors like Saba who have jumped on this as an opportunity. We have seen a lot of improvements in corporate governance, a lot more notice being paid to discounts. So when you start off in broad market terms with wide discounts and directors very focused on narrowing those up, we just say this is, I think, a really interesting time in a relative sense to be looking at this market. But coming back to your initial question, what weight do we have? We only have about 26% of our overall portfolio. So really only a little over a quarter in equities at the moment. And that reflects our concern about the equity markets in general. But we're extremely constructive on the prospect for investment trusts relative to other kind of broader equity indices.
I think it's fair to say, correct me if you don't agree with this, but there has been quite a significant response from boards. It hasn't been right across the sector, but has been in a number of places, but particularly boards of equity trusts who seem to have been pretty active in introducing policies to reduce discounts, doing mergers and so on. And the average discount across equity sectors now, I think, has been pretty stable for the last year at least. But in the alternative sectors, where the discounts are still pretty disappointing, is that the area where you have a particular focus for seeing improvements? I mean, the boards have not been so active in those sectors. It's much harder when you've got illiquid assets, as many of them do. But do you see that changing in the near term?
So maybe what I'm going to do is I'm going to talk about one individual in the sector who sits on 3 different boards. Carl Sternberg, he's the chairman of Capital Gearing Trust, so I've got to be nice about him. But he also is the chairman of Monk's Investment Trust, a conventional investment trust run by Baillie Gifford. and he's chairman of Apax Alpha, which is a private equity trust. And I just think it's very interesting to look at what's been going on there. Recently, I think it was at the Monk's half year, or might have been the annuals, I think it was the half year, he made a very clear statement, which I totally agree with, saying that essentially for investment trusts to remain relevant, there needs to be a smaller number of very large but distinctive global equity trusts. So he's pointing towards the consolidation of the sector there, but he's also making clear that the discounts have to be narrower. The successful consolidator will have narrow discounts, and they're going to be very conscious of and protect their shareholders from the risk of discount widening. You know, there are so many other options that investors have now through ETFs and open-ended funds that I think really, in order for the conventional investment trust to stay relevant, they've got to be differentiated. The boards have got to be very shareholder friendly. They've got to be large and good value. And you can really see that process going on. We've seen 10 new trusts come out with single digit discount commitments over this year. There are now over 90 companies in the sector of really, depending how you define the sector, kind of 250 to 300 companies. So getting on to a third of the companies in the sector either have tenders or statements around share buybacks. So we've really been very impressed. And as you said, the conventional investment trusts have really been leading the way. There does continue to be issues in the alternative space. And coming back to Carl, it's interesting. Apax Alpha, which is the private equity trust he chairs, it's essentially just accepted a bid from a private equity secondaries purchaser. So that will now go private. It was taken private at a discount to its NAV, but a premium to its share price. And that feels like a quite neat encapsulation of where a number of these companies are. There are, as always, a range, but the share prices remain at pretty large discounts to NAV. Where transactions can and have occurred, they've normally been at higher levels than the share price, but at discounts to the NAV. So I guess that's all to say we think that there is value in a number of these names, but it's tricky, it's complicated, and after a good first 6 months of this year of discounts narrowing in, we've actually seen discounts widening out a little again, and particularly in the renewable energy infrastructure space, they've really been quite weak. So I think it's a complicated area. It's something we look at a lot. We do have some quite big exposure to. I think there is some excellent value on offer and some very high quality companies. And there are also some companies that are subscale, seeking to liquidate into quite a weak market, trying to sell their assets into a weak underlying market. And unless you have boards capable of managing these wind downs effectively, there is scope for kind of disappointment. So, yeah, it's a bit of a mixed picture, I'd say.
Would you go as far as saying that, given that the alternative sector, there were obviously commercial property trusts, there have always been some private equity trusts, but a lot of it has been on the back of the era of zero interest rates that we lived through post the global financial crisis. A lot of them came to the market during that period. Not all of them. It doesn't seem that we're going back to that kind of era. So you would think logically, therefore, that the alternative sector will and needs to shrink a bit further than where it is today.
I think that's absolutely right, and there'll be a lot of opportunity in there. I think there are some large, long-standing names that will make it through, and amongst our largest holdings, we have names like Hickel IMPP and 3i Infrastructure. I think these are very well managed companies that have been around for a long time. They're trading at fairly wide but not massive discounts because they are reasonably high quality names. We think depending on individual companies that the current share prices should deliver long-term returns of around 9%, which is really pretty high. For equities, there will be volatility on the way through, as there always is, but I think these are quite attractive kind of levels. You have a number of smaller companies. There was, as you said, quite a lot of IPO activity between 2018 and 2021, 22. There are a number of these subscale companies that are really kind of being forced into liquidation. We're seeing a number of them essentially going into managed wind down. Some of them will manage that successfully and some won't. So on the face of it, there's a lot of value in there, but I think it's quite easy on some of these runoffs for the actual outcome to be a little disappointing. So you've got to pick around carefully, and we actually spend a lot of time thinking about that. And yes, I absolutely agree. A number of these smaller companies will disappear, but we think that the alternative sector has an important role in portfolios. It will continue to exist. The large scale companies, I think, over time will get bigger. So yeah, there's a range in there.
And I guess one should say that there is, or does appear to be in investors' minds anyway, quite a close correlation between what is happening to interest rates at the longer end of the maturity spectrum. So if they turn, then that would be positive for those that survive as well. But it does seem to be almost a kind of sort of automatic reaction that when interest rate bond yields go up, these things sell off a bit. Has that been your experience too?
Yes, there's definitely a bond proxy element to these companies, but I think the discount rate or the expected return has increased quite significantly. So essentially, in the same way that long-term returns on bonds are reasonably high compared to history, that's not to say that the prices can't go down and returns get even better. But I think we see a pretty similar dynamic, we'd say, in some of these bond proxies. They can be sensitive to bond yields, but the prospective returns are pretty high compared to historic equity returns and historic bond returns. So yeah, we would definitely expect these to be weak if interest rates sell off more, and we have seen them being quite weak in the last couple of months. But on the flip side to that, if long bonds have reached some kind of floor, and over the medium to longer term, we do expect long bond yields to come down, that these companies will be beneficiaries, and some of those discounts could come in naturally.
So finally, Alastair, we talked about a lot of things today, but a lot of macro stuff. But you also are known for being quite active, mainly behind the scenes, in prompting boards to do things to tackle discounts. Has your level of activity in that sphere been constant or going up or going down? How would you describe it? Obviously, only occasionally does it come to the surface in public. They did, for example, with the likes of PRS REIT, which is a situation that is still waiting to be resolved. How would you describe the trend as far as the kind of role that you and others play in trying to push boards into doing what you think is the right thing?
Well, we've found directors, is a generalization, much more receptive to some of these conversations, in line with some of the governance improvements, and sense that some of these companies need to be doing whatever they can for self-help. We're finding much more constructive conversations with directors. Just as an example, we like the Japanese equity market. We have exposure to that through a number of investment trusts. Our largest name in there was Fidelity Japan. That was on reasonably wide discounts, but we've been discussions in the board that they had a statement around having a single digit discount commitment. We had some discussions with the board about that over the last year, and they took that very seriously, not just our input, but input from investors more broadly. They launched a strategic review. Actually, as it's turned out, they are looking at rolling into another Japanese trust, which itself has a much tighter discount control mechanism. And I just think that's a great outcome. You know, this is an example of directors taking proactive action, identifying distinctive high quality managers within the sector, moving assets around, in the process, improving the discount control around the trusts. I really think directors in general, you know, there have been a couple of very tough years in the sector, and initially directors were quite defensive. And there was, I think, a lot of expectation that interest rates would normalize and, you know, everything would just sort itself out. But now we are seeing a lot of activity, and we've been really heartened, really. I think it does take a bit of time for mindsets to change, but directors in this sector take their responsibility very seriously. Jonathan, I know you've been a director. You know, these conversations happen on a quarterly cycle. It takes a little while to make decisions, but directors take their roles very seriously, and we have been impressed in general at the response. And I think the sector is probably past the bottom in terms of discounts, in terms of kind of pessimism. It's been a good year. As I said, it's up 12% year to date, the Investment Trust Index. We're seeing a lot of new initiatives to merge, to control discounts, to increase the relevance of products. And I think that will be a great tailwind So we're really kind of, in a relative sense, enthusiastic. I think if we didn't have what we perceive at least to be an AI bubble in the US market, we'd be very constructive on the sector. But against that backdrop, we have a little bit of caution.
Therefore, that does bring us to the final point. Just looking at your trust at its own performance, I mean, you have been very active in buybacks. You've been buying back a lot of shares over the last 18 months or so, I think. And I'm just looking at the figures here. These may not be right to every percentage point, but your annualized percentage total return over the last 10 years is around 5.1%, and inflation's been around 3%. So you've delivered around a 2% real return with, admittedly, the lowest volatility, I think, of your peer group, and probably, apart from the discount move, among the smallest drawdowns. But do you think that is a good performance, or is it one that you would hope to do better in future? One or two of your peer group have done slightly better in absolute terms.
Yeah, no doubt that's been a pretty muted period for us. Our objective is to preserve and to grow shareholders' wealth over time. The preservation bit is to try and minimize drawdown. The grow bit is obviously to grow faster than inflation. So we have, in a general sense, achieved that. If you go back to 2000, over that period, we've achieved inflation plus about 5.5%. So there are times when we have more risk in the portfolio and we're capable of delivering slightly higher returns. You know, in this current environment of rising bond yields and equity markets looking very fully priced, we have quite low levels of risk in the portfolio. We have short duration bonds. Our overall bonds make up about 75% of the portfolio. Our overall duration there, or the maturity of those bonds, is about 4.5 years. And we have a small weighting to equities. And this is really consistent with delivering inflation plus a few percent, which is at the bottom end of what we want to do. But essentially, we feel if we can get through a bond market sell-off and a potential equity bear market with the real value of our shareholders' wealth intact, that there's going to be some very exciting opportunities and a chance to kind of pick up the pace a bit. But now doesn't seem to us the time to be really swinging the bat. So, yeah, it's been a quiet period for us. But within each of our categories, our bonds have done better than the broader bond market. Our investment trust holdings have done better than the investment trust index. So we're happy sometimes to step out of kind of frothy markets and just focus on the capital preservation bit. And then there will certainly be times when we'll be using the optionality in the portfolio to step back in when prices are lower.
So that was Alastair Laing, the CEO of CG Asset Management, the managers of the Capital Gearing Investment Trust, ticker CGT.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.